Consistency beats timing. This is one of the simplest ideas in investing, yet it's the one most people struggle to follow because it goes against human nature. When you first enter the world of investing, it feels logical to wait for the perfect moment. You might think, I'll invest when the market drops, or I'll start when things look more stable, or even, I'll wait until I fully understand everything. But the truth is, the perfect time almost never feels obvious when you're living through it. When prices are low, fear is high. When everything feels safe, prices are usually already expensive. So if you base your decisions on timing the market, you're essentially relying on emotions and predictions, two things that are incredibly unreliable over the long term. Instead, consistency removes that burden completely. Rather than trying to predict where the market will go next, you make a simple commitment to invest regularly, weekly, bi-weekly, or monthly, regardless of what's happening around you. This approach shifts your focus from guessing the future to building a habit. And habits, over time, are far more powerful than occasional perfect decisions. When you invest consistently, you automatically buy more when prices are low and less when prices are high, without needing to think about it. This is often referred to as dollar cost averaging, but at its core, it's just a disciplined way of showing up again and again without letting emotions interfere. Short-term noise is everywhere. News headlines, social media, opinions from friends, sudden market drops, unexpected spikes. These things create a constant sense of urgency, as if you need to act right now or you'll miss out or lose everything. But most of this noise is irrelevant to long-term investors. Markets move every day for countless reasons, many of which have little to do with the actual long-term value of what you're investing in. If you allow yourself to react to every piece of news, you'll find yourself constantly buying and selling, often at the worst possible times. You might buy when excitement is high and prices are already elevated, then sell when fear takes over and prices have dropped. Consistency acts as a filter against all of that. It gives you a clear plan that doesn't change based on what you hear or feel. Instead of asking, is now a good time to invest? You already know the answer because you've decided in advance that you will invest regularly no matter what. This removes hesitation and second guessing. It also prevents you from making impulsive decisions driven by fear or greed. Over time, this steady approach smooths out the ups and downs of the market, making your overall experience less stressful and more predictable. Another important aspect of consistency is that it builds confidence. In the beginning, investing can feel uncertain and even intimidating. You might worry about making mistakes or losing money. But when you commit to a consistent plan, you start to see patterns. You notice that markets go up and down, but your habit remains unchanged. You begin to trust the process rather than trying to control every outcome. This confidence is not built overnight. It comes from repeatedly taking action even when it feels uncomfortable. Ignoring short-term noise doesn't mean being unaware or careless. It simply means understanding what truly matters. Long-term investing is driven by factors like economic growth, innovation, productivity, and time, not daily fluctuations or sensational headlines. When you focus on the bigger picture, it becomes easier to stay calm during periods of volatility. You start to see market downturns not as threats, but as normal parts of the journey. In fact, consistent investors often benefit from downturns because they continue buying at lower prices, setting themselves up for stronger gains when the market recovers. There's also a psychological advantage to consistency. Decision fatigue is real, and constantly trying to figure out the best time to invest can be exhausting. Every decision carries pressure, and over time, that pressure can lead to inaction. You might delay investing altogether because you're waiting for clarity that never comes. By removing the need to make repeated timing decisions, consistency simplifies everything. You create a system that runs in the background, allowing you to focus on other areas of your life without constantly worrying about your investments. It's important to understand that even the most experienced investors cannot consistently time the market. There are countless examples of professionals missing key moments because they were waiting for confirmation or trying to avoid risk. Missing just a few of the best days in the market can significantly reduce your overall returns. And the problem is, those best days often occur during periods of high uncertainty, when many people are too afraid to invest. Consistency ensures that you are always participating so you don't miss out on those critical moments. Another benefit is that consistency aligns perfectly with how wealth is actually built. It's not usually the result of one big decision, but rather a series of small, repeated actions over a long period of time. Each investment you make adds to the foundation, and over time, those contributions begin to compound. The earlier and more consistently you invest, the more time your money has to grow. Even modest amounts can turn into significant sums when given enough time and consistency. There will be times when sticking to your plan feels difficult. Markets might drop sharply, and it may seem like everything is going wrong. During these moments, the temptation to stop investing or pull your money out can be strong. But this is exactly when consistency matters most. These challenging periods are often when future opportunities are created. By continuing to invest, you position yourself to benefit from the eventual recovery, rather than sitting on the sidelines and waiting for things to feel safe again. On the other hand, there will also be times when markets are doing extremely well. Prices are rising, everyone seems optimistic, and it feels like an easy way to make money. During these periods, consistency helps you stay grounded. Instead of increasing your risk or chasing higher returns, you continue following your plan. This prevents overconfidence and reduces the likelihood of making reckless decisions that could hurt you later. Consistency is not about perfection. You don't need to invest the exact same amount every time, and you don't need to get everything right. What matters is that you keep going. Even if you miss a month or face setbacks, the goal is to return to your plan and continue building over time. This flexibility makes consistency sustainable, which is far more important than being perfect in the short term. Over the long run, this approach creates a powerful combination of discipline, patience, and growth. You're not relying on luck or timing, but on a system that works regardless of market conditions. You're not trying to outsmart the market, but to participate in it consistently. And that simple shift from timing to consistency can make all the difference in your investing journey. Grow your income and keep investing. This idea sounds straightforward, but it completely changes how fast and how far you can go financially. Most beginners focus almost entirely on returns. They ask questions like, well, what's the best investment? Or how can I get the highest percentage gains? But early on, the truth is that your rate of return matters far less than your ability to consistently add more money into your investments. If you're working with a small amount of capital, even a very high return won't move the needle much. Doubling $100 is still just $200. But increasing your income and investing larger amounts regularly creates momentum that compounds over time in a much more meaningful way. Think of investing as a machine. Your contributions are the fuel, and your returns are the engine. A powerful engine helps, but without enough fuel, you're not going very far. By focusing on growing your income, you're increasing the amount of fuel you can put into that system. This doesn't happen overnight, and it doesn't require anything extraordinary. It starts with a mindset shift, from only trying to optimize investments to actively improving your earning ability. One of the most practical ways to grow your income is by developing valuable skills. The marketplace rewards people who can solve problems, create value, or make things more efficient. This could mean improving your communication, learning technical skills, understanding sales, becoming better at managing people, or gaining expertise in a specific field. The exact path doesn't matter as much as the direction. Every improvement in your skill set increases your potential to earn more over time. Another important part is being intentional with your career or work. Instead of staying in the same position for years without growth, you can look for opportunities to take on more responsibility, negotiate your salary, or move into roles that offer better compensation. Even small increases in income when directed into investments can have a significant long-term impact. A raise that might seem modest today can translate into thousands of extra dollars invested over the years. Side income is another powerful tool. In today's world, there are more opportunities than ever to earn money outside of a traditional job. This could be freelancing, starting a small online business, offering a service, or monetizing a skill you already have. The goal isn't to overwhelm yourself or work endlessly, but to create additional streams of income that can be directed toward investing. Even a few extra hours a week, if used effectively, can accelerate your progress. As your income grows, the key is to avoid the trap of lifestyle inflation. This is when your spending increases at the same pace or even faster than your income. It's natural to want to enjoy the benefits of earning more, but if all of your extra income goes toward higher expenses, you're not actually moving forward financially. The balance comes from allowing some improvement in your lifestyle while directing a meaningful portion of your increased earnings into investments. This is where real progress happens. Keeping your expenses under control doesn't mean depriving yourself. It means being intentional. Every decision about spending becomes a trade-off between immediate satisfaction and long-term growth. When you're aware of this, it becomes easier to prioritize what truly matters to you and cut back on things that don't add much value. This creates more room to invest without feeling restricted. Investing consistently as your income increases creates a compounding effect that works on multiple levels. Not only does your existing money grow over time, but the amount you're adding to it also grows. This creates a snowball effect. In the beginning, progress might feel slow because your contributions are smaller. But as your income rises and you invest more, the growth becomes more noticeable. Eventually, your investments can start generating returns that rival or even exceed your active income. There's also a psychological benefit to focusing on income growth. It gives you a sense of control. While market returns are uncertain and outside of your control, your ability to learn, improve, and earn more is something you can actively influence. This shifts your mindset from reactive to proactive. Instead of worrying about what the market is doing, you focus on what you can do to strengthen your financial position. It's important to recognize that increasing your income often requires effort, patience, and sometimes stepping outside of your comfort zone. You might need to learn new skills, take risks, face rejection, or invest time without immediate results. But these efforts tend to pay off off in ways that go beyond just money. They build confidence, resilience, and adaptability, qualities that are valuable in every area of life. At the same time, keeping your investing process simple ensures that you can maintain it alongside your efforts to grow your income. You don't need to constantly analyze the market or make complex decisions. By sticking to a straightforward investing strategy, you free up mental energy to focus on increasing your earnings. This combination, simple investing and active income growth, is extremely powerful because it addresses both sides of the equation. Another aspect to consider is the timing of your efforts. Early in your journey, your focus should lean more toward growing your income because that's where you have the most leverage. A 10% increase in income can have a much bigger impact than a 10% investment return when your portfolio is still small. As time goes on and your investments grow, returns begin to play a larger role. But in the beginning, building the habit of investing while increasing your capacity to invest is what sets the foundation. Consistency ties everything together. It's not enough to earn more occasionally or invest sporadically. The real impact comes from doing both regularly. Every month that you earn and invest, you're reinforcing a system that builds on itself. Over time, this system becomes automatic. You don't have to rely on motivation or willpower because your habits are already in place. There will be periods where income growth slows down or becomes challenging. During these times, maintaining your investing habit becomes even more important. Even if you can't increase your contributions, continuing to invest what you can keeps your progress moving forward. When your income starts to grow again, you can build on that foundation rather than starting over. It's also worth noting that growing your income doesn't mean chasing money at the expense of everything else. Sustainability matters. The goal is to create a system that you can maintain over the long term without burning out. This might mean finding work that you enjoy, setting boundaries, and making sure you have time for other important aspects of your life. Financial growth is most effective when it supports your overall well-being rather than undermining it. Over time, the combination of higher income and consistent investing creates options. You gain flexibility in how you live and work, you're less dependent on a single source of income, and you have more freedom to make choices based on what you value rather than what you need in the moment. This is where the true power of this approach becomes visible, not just in numbers, but in the opportunities it creates and the control it gives you over your future.